You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskens, your host as always. And this week, as promised, we have WA's number one mortgage broker in the studio. It is Sam Carrello. How you going, mate?
Hey, Trent. Good, mate. Thanks for the introduction.
It is that time of year, I think, where we start talking about finances. We've already had a 25 basis point rate cut, and it is probably due as per market forecasts. All the banks are forecasting it, the markets are forecasting it, we're all talking about it. It's probably due for another rate cut very soon. We just don't know if it's 25 or 50 basis points coming. Would you agree?
Agree. Yeah, there is the expectation of a rate cut coming. A lot of the banks have priced it in. The RBA obviously catch up tomorrow, May 20. So yeah, we'll just see what happens if it is 0.25 or 0.5. There's been some pretty big numbers thrown out there by the economists. Quick breakdown is, I think most recently NAB came out and said they're expecting a 1% cut by August. They think it's going to be 0.5% May and then 2.25s because the RBA catch up now once every 6 weeks. So it has reduced from there. Looking at it, I read an article, I think ANZ were 3 cuts, 4.75 by Feb 26. Westpac CBA was saying 1%, and then NAB were at 1.25 to 1.5. So they're definitely the most bullish on the rate cuts coming, and a lot of the banks have priced that into their fixed rate loans already.
So what that means, what they're suggesting is that they believe that the RBA believes we've got inflation under control, that we're in the 2 to 3% band, that we're not going to have a lot of risk of going above that anytime soon, and therefore the current cash rate environment is higher than it needs to be. Are they essentially suggesting that balanced, neutral cash rate is more like low 3% rather than the 4.1 we started with at the start of the year?
Correct, yeah. So target band is 2 to 3% for the Reserve Bank. Looking at that, you do have just over 1%. So that's the target band if inflation's in control and the economy's ticking along nicely. Obviously, Trump factor in there. There's a few big swings as well. So it definitely interesting times. I think the overall expectation is rates are on the way down.
So what we know that when expectations are that rates will drop or go up, the market moves before the actual outcomes start to come in, right? We've seen this before. For example, when we were expecting interest rates to increase before the first increase of the last 13 that came in over the last couple of years, Sydney's prices started to go down, even though the outcome on the ground with mortgages hadn't changed yet. And so we know that expectations are nearly more powerful than realities. And whilst most of the market is starting to talk about it, I guess we start to expect prices to be factored in where people can afford to start pushing it. Now, where I'm getting to here is there's two factors. There's one factor with regards to the reality on the ground of what people can afford and whether interest rates or serviceability have been the limiter in certain suburbs for certain price points, or whether the whole market just starts to open up based on demand and supply as well. Have you had many conversations with your clients over the last year or so that's starting to maybe change on both of those things? One, sentiment, but two, affordability, like when this rate cut comes through, you can now afford X?
Yeah, I think probably the thing that's held Perth back, I mean, we've been growing pretty quickly, is the affordability piece, and that's what we're starting to see. I'm hearing the market over that 2 mil mark is slowing down a little bit, and it's just purely based on affordability.
It's not demand. It's not like people don't want to live there. It's just they can't get there.
Correct. Those aspirational suburbs, most people want to live there. It's just that they can't borrow enough to be able to get to where they need. So I think the rate cuts, if they do come in, will add a bit of fuel to the fire in terms of capacity. If most clients, if I could get them from the banks an extra $50,000, they would be putting that on the properties they're offering on at the moment because they're missing out time and time again still.
What we know is that every 25 basis point rate cut helps average Joe on $100,000 a year have a loan that's $15,000 larger. Now, this isn't saying that it's a good thing. It's just saying that's the reality. And if you do that, as the banks are saying, 3, 4, 5 times in the space of 12 months, which they're forecasting, now you start to see $45,000, $60,000, $75,000 of extra serviceability available to a market that is ready to pay it if they have to.
Correct, yeah, and that's, you've hit the nail on the head. Essentially, if we were to get, say, a 1% rate cut for a single person on $100,000 a year, it's going to increase their capacity by $60,000 on average across the banks. As a couple on, say, $150,000 a year, so $75,000 each, again, that goes up by about the same amount. So, you know, the hardest thing at the moment is obviously trying to get in the market. There's still, for good property, still multiple offers coming in, speaking to the agents. It's busy out there. I've got clients who have missed out for 3, 6, 9 months, and the market keeps edging up. So they're always chasing their tail.
Yeah, they're always falling behind. It's that non-buyer's remorse holding it back a lot of people, being a little bit too picky, in my opinion, on just getting in the market. But let's start talking about where things are at in reality. What's the sharpest owner-occupied principal and interest rate in the market right now before tomorrow's decision?
Yeah, with a 20% deposit, you're looking at about 5.89 with 100% offset account. That's through ING. Typically, we can get most of the lenders between that 589 to 599 range.
Okay, so let's say we get a 25 basis point cut in the cash rate tomorrow. Are we going to expect to see exactly that passed on, or a bit more, a bit less?
I think similar to the rate cut we had prior in the year, all the banks passed on that 0.25. I think CBA came out about an hour after it was announced and released, yep, we're going to pass it on.
It's a marketing ploy, nearly.
You'd have to have someone who's pretty good at marketing heading it up if you didn't pass that rate cut on. I'd expect to see the full rate cut passed on again this time.
Okay, so what we know is we started the year with this product for owner-occupied mortgage holders sitting in the low sixes. What we're thinking is it's going to be mid to high 4 by this time next year.
Yeah, so we took an average of the big 4 and predictions were a 1% cut. Your 589 becomes 489. And that's for a 20% deposit. We're seeing some of the banks for the lower LVR stuff, sub 70%, maybe offer an extra 10 points off that as well. So yeah, in February, March next year, hopefully there's falls we're seeing out there for owner-occupied principal and interest loans.
So what's our average loan size at the moment across the state? Do we know? Is it 500-600 grand? It's around there, isn't it? 1% easy, 5-6 grand a year we're saving in interest. So that's going straight into people's savings or back into the multiplier of consumption.
Yep.
But it's what people have been waiting for, and it's what has been making it tough for a lot of, as the politicians will say, doing it tough in the household. This starts to release the valve again. We're certainly not going to see it get down to a 2% interest rate again, where the whole game changes on people's savings and a mortgage relationship. But I expect if we can settle in that 4, is most people comfortable enough in Western Australia?
Yeah, I think with the median price, we'll be okay over here. The median continues to grow, but I think we'll be okay. It's interesting, serviceability is the hot topic. There's that 3% buffer in there that some people have called to get reduced down to, say, a 2.5 or 2% because they think it is over the mark.
Especially when we expect rates to go down in the future, right?
Yeah, and we've seen a couple banks. So I know early in the year, the government came out and said we need to look at this HEX debt issue, right? We need to look to see if some clients might pay off their HEX in a year, but at the same time, the bank see that as essentially a 30-year commitment when they assess them. That sort of came out early in the year. The only bank that's moved on that's Commonwealth. So they've brought out a scheme, or I guess an assessment, where based on the income that the applicant's earning currently, if they're going to pay that help debt off within the next 12 months, you can completely ignore the help debt. If based on what they're currently earning, it's going to be paid off within the next 5 years, they'll take it at a desensitized rate. So essentially, rather than the buffer rate on the mortgage being 3%, they'll look to assess it at 1%.
This is all, again, inflationary, isn't it? It's giving people more serviceability with the same income by disregarding current debts, or, to be frank, treating those debts a bit more fairly, because we know they're short-term debts. But really all it's doing is giving people more purchasing power. Where there are more people putting an offer in than there are houses, that sends prices up, doesn't it?
Correct, yeah. The demand, it's just like, even I'm sure we'll touch on later, is the government grants, but the demand side will receive a lift on this, but the supply is where the issue is.
Yeah.
We've got that help debt one, and I think Commonwealth also, they're leading the way in terms of new policy, but they've brought in, if you're a home buyer and you declare that you're going to lease out a room, have someone in boarding, typically the banks won't take that income into account, but Commonwealth have said if we get a stack deck from the client to say they're going to lease out that room, they will then add $150 a week income.
Sounds like a lot to me.
Yeah, I think it's, obviously they're putting it back on the client with them getting to sign the stat deck, because what happens if the client does that and then doesn't lease out a room? I'm very mindful that you need to make sure that when you're assisting clients with loans, that you have that conversation that, all right, cool, the bank are going to lend you X, but where are you actually comfortable at?
I think they're having conversations about real life situations, especially in places like Sydney, where they are probably leasing out all their rooms just to pay the mortgage.
Yeah.
They may have got help from mum and dad for deposits, but really when it comes to just affording the mortgage, they're still in that reality of leasing out, subletting rooms. And I did the same thing back when I was in my early 20s. So it is a reality for people, but it's certainly one that I'm pretty sure the banks aren't going to be checking up on unless you aren't performing on your mortgage in the first place. So I can see a lot of people taking advantage of that. Let's talk about what people can actually afford right now. We know that average Joe makes 100 grand in debt. What can they afford with regards to their lending capacity right now?
Yep. So currently, a single person on 100,000 with no debt can lend that $520,000 to $550,000 mark.
Okay, with rates going down as per what the banks are expecting over the next year, that really gets up to about the 600 mark nearly, doesn't it?
Correct, yeah, just over 600.
The thing that's confusing me a little bit in terms of where the money's coming from is that I expect most of these people haven't saved over $100,000, a 20% deposit to get to that position without LMI. And we know that the median house price in Perth is over $700,000 now. So what is average Joe buying with his $520,000 to $550,000 in lending plus, let's say, a 10% deposit right now? They're probably stuck in the unit space or the older apartment space.
Yeah, that's what we're seeing. I think, especially probably the last 6 months, people have put the value on amenity. So a lot of the first home buyers, or some first home buyers now that we speak to and assist, they're happy with a 1-bedroom or a 2-bedroom apartment in your Highgates, Perth, West Perth, East Perth. They're putting value on that rather than it necessarily trying to get that 3x2, because ultimately it comes down with the way prices have gone, its location or size of property, and a lot of them are seeing the benefit of being located somewhere central where they want to live rather than needing the extra spare room and maybe transit to and from work 45 minutes rather than being able to take the bus down the road.
What about the whole idea of rent investing? Are we seeing a lot of people trying to make that gap up by maybe starting it off as an investment property with proposed rental income to make up that serviceability gap?
I have seen a lot on social media about the Rentvestor. I think it's probably a bit of a flavour at the moment. So we have had some clients where they might be in a share house in a nice central location, but they want to get into the property market. So what they're doing is, they're buying a property a little bit further out, somewhere they don't necessarily want to live, but it gives them the opportunity to get in the market and see a bit of that growth. So they'll continue renting where they are and then, buy a property a little bit further out and obviously rent that out and at least they're in the market.
Talking about renting, investor rates, right? Are they clipping into the fives yet, or we're going to need a rate cut tomorrow to do that?
Yeah, we'll need a rate cut. There's a couple of principal and interest rates. If you're that sub 70%, I think Westpac, we've done a couple at 5.99, same as Macquarie ING. That's for principal and interest, but so interest only, typically you're sitting around that 6.3 to 6.4 mark.
Now, one thing I think that's going to make a big difference to where people are buying and their limitations, as we've spoken about on this episode already with regards to serviceability, is the Help to Buy scheme expanding. Now, we know that Help to Buy scheme is the federal government's version of Keystart. Much better in my opinion, because the rates are actually competitive with what the rest of us are paying. We're not getting shafted on rates like with Keystart, but it's a 5% deposit, so at least asking you to pull together $40,000-$50,000 rather than $10,000, which I think is far more pragmatic from the federal government compared to the state government in that situation. But the big key here, which has been limiting especially house and land packages, whether you like them or not, which is where a lot of first home buyers like to go, is that their policy that they haven't actually legislated yet is to increase the threshold in WA from $600,000 to $850,000, which opens up, to be frank, nearly most of the urban fringe packages that are over 325 square metres in land size. And that really, I think, is going to be a big flavour, a big pusher in the price of land and the price of housing again as more demand comes through, as this threshold just opens it up. Do you reckon the government's just given up on the supply side and thought, if we can't fix supply, let's just help people out with the thresholds on the demand and just let the prices run?
Yeah, I think you hit the nail on the head that it doesn't help supply. All it's doing is increasing to demand. So they've increased or proposed, so it hasn't been passed yet, but they've proposed as at the election. One of the promises was they would increase in WA up to $850,000 for your purchase price. The other thing, which is probably, I think, going to have a greater effect, is they've removed the income cap limits. So prior, it was $125,000 for a single or $200,000 for a couple. Now it's unlimited. So you could have
just open slather for everyone.
Correct. So a lot of we would speak to some clients that they might be doing FIFO, so they're on the $160,000, $180,000 a year. They didn't qualify because they're earning too much.
But maybe they didn't have the savings either because they're spending it on toys.
Most would be able to couple together that 5%.
Exactly, but maybe not the 20.
Correct. But they didn't qualify for it anyway because they were earning too much. Now with that income cap gone, some of them that we see can have 3-4 good months, put their deposit together, and then away they go.
Now, I guess at the end of the day, we do want everyone having a roof over their head, owning their own house if they want to. But yeah, it certainly seems like something that's going to probably send a lot of properties, or I'd say most in that sub 850 space, into overdrive. And it's just going to open up all those people who are renting. And look, we do want to get them out of the rental market so we can import people who have trades to be able to actually help with the supply side. But I see when that policy is enacted, that is going to be massive fuel on the fire, especially for the land side in WA. Does it help with off-the-plan apartments? I don't think that's where most of the marketing is tilted for most of this cohort of our population. But yeah, the increase in thresholds and the removal of the income limit just sends it open to slather, in my opinion, for all property to push up to that 850 mark at some point in time. Let's move to the Help to Buy scheme.
Yep.
Can you explain that?
Yeah, so essentially, Help to Buy scheme, government will co-purchase up to 40% of a home.
So that's like the Keystart shared equity scheme.
Yeah. So say I want to buy something for, say, $700,000, but I only can afford a mortgage of, say, $500,000. The government will purchase the other $200,000.
Okay, so it's really for those people who probably could have gone to the 5% first home buyers grant scheme, but for their income limitations. Because really,
Correct.
Otherwise, you'd just go do the 5% and own the whole house, wouldn't you?
Yeah, it's for people who probably don't have that serviceability aspect. The government are going to come in and buy a portion of the house for you.
That looks like a single mum scheme to me, which I think is really helpful. Someone who's maybe only able to work 3 days a week because they're looking after the kids. You see it a lot in the mortgage broking space where, the income's a limiter. You might be looking to get something from the pension or from child support agreements as well to get them over the line from a servicing side. But if it can, again, get them out of the rental trap and get them into their home, that's got to be a win, I think.
Yeah, there's obviously studies that have proven there's massive social benefits to people having a home and having that certainty. So, yeah, I think it's not a bad policy to try and help people. Again, I think it will increase the demand side. Again, it's not fixing supply. It's essentially just letting more people enter the market.
So one thing I think that comes across our desk a bit still, even a couple of years now after people have been imprisoned in their mortgage back when they got their 2% mortgage and, to be frank, couldn't afford to get it again now. Those people who are hoping to get a better deal on their interest rate, the bank that they're with knows that they can't move, and so they can't really negotiate a better deal, but they can't get out of it because of the 3% buffer rate you were speaking about earlier. Can you explain to me a bit more the couple of banks that are offering a more pragmatic solution in that refinance space?
Yeah, there's a few lenders out there who, if you've had your mortgage typically for 12 months with good conduct, they will reduce that buffer rate from 3% to 1%. It's like an alternative serviceability assessment, essentially. So it just reduces the buffer, and that might be the difference between a client being able to refinance and not. So you could have someone stuck at mid-6s, 6.8. They can't refinance because serviceability wise on the 3% buffer it doesn't work.
They're being assessed at 9.8%, really, aren't they?
Correct, yeah. So you can't just sign up at Bank A to get in at a higher rate potentially and then 2 months later want to do the alternative assessment. You have to have 12 months history.
Okay. But look, that is an option for people who are still stuck and struggling with their mortgage. If they are paying it and they have been and unsatisfied with their mortgage, if they have been paying it and they're stuck in the high 6s and we want to get down to maybe the 5.9s that you're talking about at the start of the show today, CBA, Westpac, any other banks that offer it?
Yeah, most majors do. ANZ, NAB, Bankwest.
That's great.
So they do offer that alternative assessment, and that's it. So you can prove you've been paying it, which is good. So it's just helping you out. I always recommend have a chat to your existing bank and see what they can do. But if they come back to the party and say, oh, sorry, Sam, we can't move the rate on them, then yeah, that might be an option to be able to give you a bit of relief over the next few months.
Sam, your last question, and I guess it's a personal one, but it's one that I think people would want to know because they look up to you with regards to your ability to manage mortgages for other people. If you were that first home buyer looking to get into the market, we've spoken about the first home guarantee scheme. We've spoken about Keystart before, about the idea of rent vesting and using proposed renting your property out for a little bit before you actually move in and make it your home one day. Which pathway would you take? Personally, let's say you had a 10% deposit ready to go, your servicing wasn't an issue, and you really wanted to get into the market, but you really weren't sure which product to go with. Is there a pathway that you'd take to secure that first property, whether you're going to live in it or not for now?
Yeah, I'd probably go with the government guarantee scheme. I think you can get in with as little as 5% deposit plus your costs, so stamp duty, etc. But you're going to be on a really sharp rate. You're in those 5.9s typically. And I think, yeah, being able to own the property 100% and it's somewhere that I want to live, if I could do that, that's the way I would go.
It does sound like a very generous scheme that is really broadening out every single person who's been left behind in the last 10 years of the property cycle nationally, whether they make $500,000 a year or $100,000 a year. Seems to be a bit of a trawler's net, a rake, just capturing everyone who's been left behind and saying, hey, I know you missed out, I know your deposit keeps falling behind every month, but you can jump in now with this scheme. It seems like a great opportunity to just take that leap before it all falls behind again.
100%, especially with those proposed increases to the purchase limits and stuff. Yeah, if you could borrow up to $850 with a 5% deposit with stamp duty, etc., you probably need about $75,000.
That's years of savings. To only have to save $40,000 plus stamp duty compared to $170 plus stamp duty. What you're doing really is you're just making up for years of falling behind, or you're bringing forward that opportunity years in advance if you've been saving since, for example, high school and you just got to the 40. It just seems like a real capture-all moment for everyone who's missed out or wants an opportunity today and doesn't want to fall behind in the future.
Yeah, and I think if you can get in now and afford it based on today's rates, with the forecast that they will come down, I think demand's just going to increase. You know? So I think if you can get in and buy that property.
These schemes, they are expansionary. They are inflationary. They make prices go up.
Correct.
If you can be the first guy on that train before they do go up, invariably, it's better than missing out yet again.
Correct.
Sammy, thanks for coming in, mate. I appreciate the update on rates, the update on policy, and what that means for us in Western Australia with regards to prices going forward. Good luck to everyone out there in the market right now, whether you're an investor or you're a first home buyer or looking to upgrade. The first quarter was a bit of a noisy quarter with regards to tariffs, with regards to 2 elections in our state, but my forecast continues to be that the rest of this year will see us get up to a 10% increase in prices. Now, does that mean $70,000 more expensive, $100,000, $200,000 more expensive on the home you're looking at? Whatever that number is, please have a look at what you can afford. Make sure that you find an opportunity in some weekend soon to not fall behind in what is continuing to be the tightest market we've seen in our lifetime.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!